Now, should you buy the properties in your name or should you buy them in a limited company? Well, if you buy them in your own name, you've then got Section 24 to deal with. In a nutshell, Section 24 is basically you cannot claim all of your mortgage or finance costs. So if you become a high rate taxpayer or your rental income pushes you into the higher rate of tax, you only get a 20% tax credit. Whereas if that weren't the case and you're a high rate taxpayer, you'd get 100% relief. So that's something you need to be aware of. And it is going to be quite costly. You had something called wear and tear relief, that's no longer available, so that's something you need to take into account. But if you're not into property already, then you won't know of that, so that's not going to be as crucial for you as it was for those who were in property a number of years ago. That's been replaced by the domestic replacement allowance, I think it's called, I always forget the name. So you can still claim for goods, but not the first time you buy them. So if you buy a fridge for a property, you can't claim it the first time around. Even when you sell it, you can't claim the cost of the fridge. When you replace the fridge, I think it's called replacement of domestic items. When you replace the fridge, you can then claim for the replacement. If you replace the fridge with the fridge and freezer, you can only claim the cost of the fridge and not the freezer. So you got to keep good records. The good thing about having property in your name is that it's flexible, and also you keep all the control, and there are lots of mortgage products available out there, and the interest rates are pretty low. The disadvantage is you've got unlimited liability, so you're responsible for everything. You're next on the line. You've got Section 24 to worry about, and that is going to be quite painful. And then you've got to pay income tax on your profits. That means if you have a job somewhere and you're working full time, your property income or profits will be added to it, and then you've got the added paying of Section 24. So you could end up paying a lot of income tax, even though you don't take any money out of your sole trader account for your property business. You leave it all in there because you want to reinvest it. Now your other option, apart from having a partnership or a limited liability partnership, your other obvious and main option is having a limited company. So the good thing about limited company is it's a separate legal entity, and the risk is ring-fenced within the company and you aren't personally liable. Another benefit is you only pay corporation tax at the moment at 19%. So if you're looking to recycle all of those profits into buying more property or putting up more deposits, let's say you made £10,000 profit, you'd pay £1,900 in corporation tax, and £8,100 you can invest in the next property. It doesn't matter if you have a full-time job, as long as you don't take any money out of the company, you don't pay any tax. And the first £2,000 you take out anyhow are going to be tax-free. If it's a dividend, as long as you don't have any dividends from elsewhere. So that works really well. Like I said, you can reinvest more of your profits. That works well. If you're looking to add other shareholders or directors, you can do that pretty easily. There would be tax consequences for adding other shareholders because there would be a capital gain if you sell some of your shares to them. So speak to a tax advisor and they'll tell you more about that. Then you've got the opportunity to add your children or other family members to the property business by way of having alphabet shares or growth shares. Again, talk to an accountant and they will be able to tell you more about that. The disadvantage is, of course, there's double taxation. So when you take the money out, you've paid corporation tax, then when you take the money out personally, you then have to pay income tax depending on the total salary plus dividends. If you're taking a dividend, if you don't have a job anywhere else, you've got your personal allowance and your £2,000 tax-free dividend. But if you have a job elsewhere and you've got dividends coming in from elsewhere as well, then any money you take out of your property business, you're going to have to pay further tax on it above and beyond the corporation tax. Another disadvantage is there's limited choice compared to having properties in your own name in terms of mortgages and lending products. So it's tighter. Now linked with that, the rates are higher. So the interest rates on buy-to-lets through a company are going to be higher than they are in your own name.